sent to the US Federal Reserve to lower interest rates. Incoming chair Kevin Walsh instead may have to push for higher levels to establish credibility. If the new central bank leader fails to signal that policymakers are attuned to inflation pressures, it could risk further market wrath in the form of escalating treasury yields. And then you may have to face the wrath of bond vigilantes. Walsh is set to chair the June Federal Open Market Committee meeting, FOMC as it is popularly called, but who is actually in the monetary policy driver's seat? We would argue that it is the bond vigilantes. Is it President Donald Trump? So, Walsh is going to be the odd man out because most other people don't think that it's good time for interest rate cuts. He is the new Fed chair and the bond market is reacting badly to his dovish stance so far. Treasury yields surged on Friday with the 30-year bond eclipsing 5% to its highest in near a year. It came about 5.12%. The long bond on Monday morning was little changed at 5.138%. The 2-year treasury, which is more sensitive to Fed rate, moves edged lower to 4.07%. In statements prior to taking over the chair's position, Kevin Walsh has said that he believes that the Fed can lower its benchmark interest rate from its current targeted range of 3.5% to 3.75%. However, a recent surge in inflation, triggered largely by the Iran war but also owing to other underlying factors, has led to markets repricing rate expectations. But it's gotten more complicated with Kevin Walsh's arrival. Not only does the market not believe that the Fed will cut, but also rising for a hike, with current pricing implying a 42% chance of an increase by the end of the year 2026, according to CME Group's FedWatch tool. So here we are. The scenario has changed quite dramatically from an interest rate cut to an interest rate hike. A tightening bias from the Walsh Fed early will keep allay the bond market concerns and keeping a lid on yields and allowing the Fed flexibility later on. So by acting hawkishly, Walsh might have a chance of delivering what the White House eventually wants, that is lower real-world borrowing costs. Mortgage rates could fall, corporate financing could ease, and Trump can point to declining long-term yields as the economic win. That's exactly what President Trump wants as the country, United States, heads towards its midterm elections. So it may be a bitter pill to take, but a short hike in interest rates may show that they are also worried about inflation. Now, one thing can change this entire scenario, and that is if this Strait of Hormuz comes to an abrupt opening. If, let us say, the headline news or this weekend says that Strait of Hormuz is open, then oil prices, although not immediately, but there could be a good steep fall that may take place over the next few days and weeks, which would automatically be reflected in lower inflation figures in the CPI and PPI numbers to be released over the next few months. That would automatically bring down the affordability costs, and therefore the pressure on the Federal Reserve to hike interest rates would reduce, and to reduce interest rates, the pressure could increase, and it would be a win-win situation for the Republicans and also for the Federal Reserve and also for President Trump, as he is very keen to bring down the interest rates to be able to tackle the American deficit problem, and also that would stand in good stead because lower interest rates would be good for the mortgage market, for the corporate financials, for people who are borrowing in the corporate bond market, and also for the retailers of the credit card debt. And this all would be augur very well to bring down the cost of living, and therefore would be a happy situation as the Republicans head into the elections or the midterm in November of 2026. So headline news can change this entire scenario. And yes, if you're watching my video for the first time, do like and subscribe and pass it to people who would find it equally useful to know about the US economy, the US stock markets, the world economy and the world stock markets, and would love to share more views with you. Have a great investing week ahead. Take care. Bye-bye.